Hello everyone and welcome to the BDO Financial Reporting Update webinar today. So my name is Elise Noble and I'm joined today by Anthony Appleton. Anthony has recently joined BDO's Technical Financial Reporting team as a technical partner. So we're presenting this webinar today live, so I'm hoping we won't have any technical issues, but if we do, just as a reminder, there will be a recording of the webinar available through our website, and the link will be sent to you, I think, by email. So you could always listen to that at a later date if we do have any kind of problems with the audio or connectivity or anything like that. If you have any questions during this webinar, you could use please use the Q&A function that you should find on your screens and address any questions to all panelists. We'll take a look at those questions, and if we can answer them during the webinar, then we'll try and do that, and if not, we'll try and get back to you individually. So what have we got on the agenda today? Firstly, we'll begin by talking about the latest financial reporting considerations and updates from the coronavirus pandemic. As we have been doing this year, Anthony will be taking us through some of the latest guidance and amendments and reliefs coming from the FRC and the IASB and others. And we'll also explain about a new model called RETHINK that BDO has developed and which could be useful. After that, we'll take a look at some other recent financial reporting news, and this will include some IFRS updates, including on IBOR reform and some other recent amendments, and a few UK GAAP updates, and we'll finish by taking a look at something from the IFRS Interpretations Committee on the topic of supplier financing or reverse factoring. So I'll pass you over to Anthony now for the latest on COVID-19.
Many thanks, Lisa. Yes, good afternoon, everybody. Obviously, coronavirus continues to be a huge issue for the whole of society, but in our narrow financial reporting world, yes, it continues to be an issue for preparers of financial statements, but also for regulators and accounting standard setters. And so in this little session, I will take you through some of those developments. Next slide, please. Before I get into the detail, though, as Elisa mentioned, I just wanted to talk a little bit about RETHINK. RETHINK being a model that BDO have developed to help companies think through and plan for the future during the coronavirus. Now, this is a model we're applying internally for the way we're managing our business, but we're also using it as a way of speaking to clients, both audit, tax, and advisory clients, on just giving them some thoughts on how they want to think through their recovery and planning through the COVID crisis. Now, what this model does is consider that to be three overlapping phases, as shown on the page there: react, resilience, and realize. Now, the react phase is all about how we absorb the initial impact of COVID as a business, and manage those initial concerns, the initial impacts as we first went into lockdown and we first found impacts to both our relationship with customers, supply, and elsewhere. Resilience, the next phase, is about how do we adapt during lockdown, and what are the changes we've had to make to our business, our operating procedures, perhaps even temporary adaptations to our business model to help us to work in this transitional phase. Then the third phase we identify is realize, which is looking forward to how will we operate in the new normal. What kind of changes will affect our market, our customers, and how will we best operate in the future? Now, as I said, this is a model we use for considering business planning. But the model is also useful for reporting in that if we think clearly in terms of each of those phases, we'll find that there are things we should be including in our annual report. So in terms of the react phase, this is all about reporting the initial impact of the pandemic. So in terms of impact on financial performance, the key thing is there to be transparent and balanced. Investors want to understand what the impact is, but we've got to be a little bit careful because the regulators have highlighted some skepticism about the use of alternative performance measures right now. Basically because, alternative performance measures should be consistent over time, and changes now will then lead to further change in the future post-COVID. But perhaps what we can do is still trying to highlight, how did performance differ before COVID and after? What did we have to do to try and maintain our performance? Reporting in the balance sheet will show that initial impact too. Now, important point I've highlighted there, this should be based on expectations at the balance sheet date. We must avoid the use of hindsight. So, for example, if we were thinking about impairment reviews, we would be basing them on the expectations, the reasonable expectations we would have had about the future at the balance sheet date. We shouldn't be using hindsight to say, well, this is what actually happened, thereby we can go back and change our impairment model. But investors obviously understand that these are uncertain times, and so much of the measurement will be based on forecasting assumptions of the future, and so we should be disclosing those. What were the assumptions that were driving these balance sheet measurements? What sensitivity analysis are you able to provide to put those amounts shown in the financial statements in some kind of context? You might also need to think about additional liabilities, whether you've ended up with onerous contracts because locations have been closed, but the lease remains. Also, in terms of the react phase, we'd also expect to see some things in the narrative reporting section, so particularly the strategic report. I'm thinking, what did happen? What were your responses to the pandemic? And with the closures, with the relocations, how did you work with your workforce to ensure that they were protected, but also their skills and experience retained? So, in terms of the strategic report, there will be some element which is looking historic. What did we actually do? But the strategic report is also a forward-looking report. So, in the resilience phase, I'll be looking at what was happening as you try and adapt your business model post the balance sheet date. What steps have you taken to preserve sources of value? Because, as Elisa mentioned, I've recently rejoined BDO from the Financial Reporting Council. And in all our interactions with investors at that time, the first thing that they raised was about liquidity and is there the cash and the finance to absorb the shock. But the second thing they always mentioned was, and we want to know what they're doing with staff and other drivers, sources of value. So how are they ensuring that they retain the skills and experience that would be necessary to manage a recovery post-COVID? Similarly, they want to know what you're doing to protect your brand. We can all expect that after we come out of this, which I know it now looks further into the future, the questions will be asked, what did you do in the crisis? So what did you do to protect your brand? Moving on, going concern assessment, investors will expect to see more material uncertainty disclosures, but the key thing is, you've got to base those assessments on all information to the date the accounts are signed. So whilst in impairments, it's based on your expectations at that balance sheet date, your going concern assessment should be reflecting everything you've done during the resilience phase, but also must reflect your expectations about the future. So again, we then can look forward to the realise phase. And realise, as I say, is all about what will happen to our business model in the future. How can we expect the economy and customers and society to change, and how will we incorporate that into business model for the future. And investors will want to know that you are thinking about this, you have plans for this future, and you are both monitoring and integrating changes now and future expectations into your business planning. Similarly, viability statements will need to look forward to and reflect what will this new business model look like. Now, in each of those phases, there will be further things that need to be reported. This was really just a sort of a snapshot of the kinds of things that you can get from this model. But I would encourage you to speak to your BDO contact about Rethink and how it might help you. But also, I think when you're preparing your accounts, if you think about those three phases, it generates content that will be necessary for your report. And finally, overall, why should you be doing this? It's to create investor trust. So do remember, transparency, clarity, and balance is what they will be looking for. Next slide, please. So now into some of the detail. Now, some of these things you have seen on previous webinars, so some of them I will deal with quite quickly. But just to update you on the Corporate Insolvency and Governance Act, we've mentioned what we were expecting in this. That has now received royal assent. And remember, what this is doing is in providing some of the temporary easements for hosting AGMs in COVID-secure ways, and providing filing extensions, putting them into law. It also introduced changes to the insolvency regime and providing relaxations against accusation of unfair trade, illegal trading, and when insolvent. And it is just about providing some breathing space in these difficult times. The secondary legislation that came with it, the filing requirements and temporary modifications, these just put into law and made automatic some of those extensions in filing I talked about as well previously. So the extension to filing your accounts with Companies House. Do bear in mind, if you are a listed company or your company traded on AIM, you do need to also consider the current state and the current extent of the filing extensions to the market. In this case, we're really only talking about filing at Companies House. Next slide, please. So now on to some of the detailed changes in standards we've seen just recently. First of all, well, we've received many questions, frequently asked questions, obviously, about coronavirus, and this one in particular around rent concessions. So your landlord has provided you with a rent concession. This might be rent deferral, so you'll still pay the rent but at a later date, or a rent holiday where you have a period rent-free. We'll see, we deal with each of those differently. Well, currently under UK GAAP, the requirements would lead to, as shown on the slide. Firstly, in terms of a rent deferral, well, this overall rental payment is going to be the same, so we'll continue to straight line lease expense in the normal way. We wouldn't expect there to be any significant change in the overall cash flows. It's mainly a deferral. However, if there's been a rent forgiveness, so the total rent over the lease term you'll pay has fallen, currently under 1 or 2, you would be required to adjust that prospectively. Think about any pre-existing balances on your balance sheet relating to past lease incentives, and then look forward at the new estimate of the future cash flows and spread that total evenly over the remaining term. Now, that will change though, because under FRED 76, the FRC have proposed some changes to FRS 102. Next slide, please. And so what does FRED 76 do? It proposes mandatory requirements to change the accounting for rent concessions. Now in this case, it only applies to formal rent waivers or forgiveness. If there is just a deferral, the normal rules will apply. There's really not been any change in your straight line expense. But if there's been a rental holiday provided or some forgiveness, then what you need to do under this requirement is actually nothing. You just do not recognise any rent in that period. Assuming that it was a total rent forgiveness, you just show no expense in the period for which the forgiveness has been provided. Obviously, if there's a reduction, well, then you just recognise the reduced amount. Key thing is you don't look forward on a straight line basis for these rental waivers or forgiveness. You just recognise that there was a reduced expense for this month, and that will be our expense as well. If it's passed, and it looks like it will, we've been in discussion with FRC, they do look to be proceeding to finalisation. Well, and it's expected to apply to periods beginning 1st of January 2020. What effect does that have? Next slide, please. Now, it's probably not a surprise to see that this can only be applied in very narrow circumstances. Now, the standard explicitly sets out 3 criteria, but implicitly there's a 4th one. So firstly, it's only lease concessions that are a direct consequence of the COVID-19 pandemic. So that's what I mean by a 4th condition. You've got to be able to show that the change in the lease payments is a direct consequence of COVID-19. Now, if it is, then the standard will lead you to these 3 criteria. Firstly, that the change leads to you paying less consideration. So that was a saving to you. It is only applicable to payments that will be due on or before the 30th of June 2021. And thirdly, there's been no other significant changes to terms and conditions. You can't use this as cover, if you like, for not prospectively dealing with a lease that's effectively been renegotiated more widely. It's only applicable if the amendments that have been made are purely due to COVID. Now, we do wonder whether they will, I do wonder personally whether they will look in that second criteria again about only payments due on or before 30th of June 2021, simply because we've seen already that COVID is going to have a longer lasting impact. There will be elements of restrictions for longer. I think they're probably set in the ways. I think they will probably stick to 30th of June 2021. But I think they should just pause and just consider whether that's still the case, given the government announcements this week. Next slide, please. Now, I mentioned there about the effective date. Worth just thinking about that a little bit. It is, as I said, it will be mandatory for years commencing 1st of January 2020. So if you had, let's say, a 30th of September year end this year, you could choose not to. Could choose not to apply it. So, let's say that we get this in place by late November. You're producing your accounts in December. You have a choice there as to whether to apply the amendment or not, whether to early adopt or not. Obviously, if you apply your accounts before it's finalised, it's not available. But let's assume it's been released and you're considering whether to apply it to your September year end. You don't need to early adopt, but it's important to see that it is applied retrospectively. So if you choose not to apply it for a September 2020 year end, next year you will only have to go back and amend your accounts anyway. So on the whole, it seems the best policy will be to apply as early as you can once it's been finalised. Next slide, please. Now, what about under IFRS then? What's the accounting in the same situation? Well, as currently stands, or as would stand in IFRS 16 before some amendments, the first step would be to consider whether it's a modification of IFRS 16. What IFRS 16 has, in a way, a sort of similar approach to financial liabilities. It requires you to consider whether the changes in terms and conditions are substantive and drives the way that you would account for the modification. Now, back earlier this year, I think it was in about March or April, the the ISB issued some educational guidance to talk us through that. So we need to, under that guidance, we need to consider the change, consider whether it is a lease modification, and that involves considering whether it's changed the scope of the lease or it's changed the considerations. Not all changes will be modifications, but you have to go through and assess it. That in itself is an additional challenge. We'll see in a minute, and also what the accounting implications of that are. So you have to consider whether it's a modification, and then follow the standard for changes in the accounting. As you're probably aware, the ISB have then issued some amendments to IFRS 16, and the aim of that is to reduce the complexity of having to go through that process of looking at every lease and saying, is it a modification or not? Next slide, please. Now, if you don't apply the practical expedient that's been brought in by IFRS 16, well, then we're in that middle column. Practical expedience not applied. What you have to do, first consider whether it's a modification. If it is a modification, you would then have to reduce the lease liability because you'd be reflecting a revised consideration. And now you've got revised consideration, you have to recalculate an appropriate discount rate from the date of the lease modification. So that's another layer of complexity. You would then adjust the carrying value of the liability, as I say, with the other side going to the right of use asset. You would put an offset and adjustment to the right of use asset. And it would have no effect on profit or loss because that double entry was liability to asset. Now, if you apply alternatively the IFRS 16 amendment, this practical expedient that the ISB have introduced, well, you don't need to go through considering whether it's a modification. You just treat it as if the change in the rental is akin to a variable lease payment. So yes, you still need to look at what your future payments are now going to be, what have you now agreed following the rent concession. But you don't need to change your discount rate. You carry forward the right of use asset. There's no effect on that. But instead now, the change in the liability is taken straight to P&L. It's the difference between the old lease liability and the new lease as calculated with the application as practical expedient. So, applying the practical expedient does lead to an entry straight to P&L, but it significantly reduces the complexity in application. Next slide, please. Now, we've provided, you can access via our website or via our contact at BDO some publications from BDO Global and our network. Firstly, on lessees, FAQs for lessees, and can you apply the expedient? What's the calculations once you do? And indeed, what do you do if you don't apply the practical expedient? And many illustrative examples to help you through that. If you are a lessor, there's a separate publication basically dealing with the accounting for that. Remember, no practical expedient has been provided for lessors, so this is going through implementing IFRS 16 in its original form. Next slide, please. Now, as IFRS 16 has been amended, that amendment needs to go through the European endorsement process. So normally, you can only apply one of these amendments if the EU has fully endorsed. Now, my slide turns out very soon to be redundant. I am hopeful that the EU adoption process will be completed before the end of September, but nothing can ever be taken for granted. But because the European institutions could see that some companies might have wanted to apply this expedient in advance of the endorsement, ESMA made a statement earlier in the year, about 4 to 6 weeks ago, I think it was, saying that they won't take regulatory action against any companies. Sorry, they wouldn't make it a priority to take action against any companies that apply the amendment earlier. The FCA and the FRC have built on that statement and have said, look, they will not take action against a company applying it. You must disclose that you're applying the amendment as issued by the ISB rather than an EU-endorsed amendment, but they're giving you the green light to go ahead and do it. Unfortunately, though, they haven't made any similar sort of statements about the auditor, and have really reminded the auditor that the audit opinion is about compliance with the EU endorsed standards. So it looks inevitable that if you do apply these amendments before endorsement, either your audit report or your interim review opinion will need to be modified. And it also tracks on to other things, such as if you make a dividend and based on those accounts for which there's been a modified audit report, and the auditor will have to provide also a statement around whether that modification is material for your subsequent calculation of distributable reserves. As I say, I'm hopeful that this will be a redundant slide. I'm hopeful that that endorsement will be within the next week or so. But as I say, nothing is guaranteed through the European institutional processes. Next slide, please. Now, I said this was COVID was of interest both to standard setters and regulators more broadly. Well, the FRC, through its corporate report and review panel, recently issued a thematic review looking at the early accounts that were issued during COVID and looking at the financial reporting of these. And this thematic review, I think, can be read also in conjunction with, or should be read in conjunction with, two reports of the Financial Reporting Lab on what they think investors are looking for in terms of COVID-19 reporting. Now, what the COVID-19 thematic review does is it really highlights examples of where there's been good practice in the disclosure around COVID, but also where things could be improved. Now, the thematic review itself as a report really is quite long, but it's certainly worth reading. And bear in mind that the reason for the length is there's just lots of useful illustrative examples you can dip in and dip out. Now, these examples might not all be directly relevant to you, but they really do highlight the principles of what the regulator is looking for in COVID-19 related disclosures. In particular areas of interest are impairment reviews, expected credit losses on receivables, fair value measurements, and other areas. Next slide, please. Now, the overarching message you get from this thematic review is the need to provide investors with high-quality forward-looking information. This information should be specific to the company and explains what the company has done in detail. You know, areas that really highlight going concern disclosures, not surprisingly, they're highlighting their key assumptions and judgments and the disclosures around those. Constantly an area of focus for the CRR. So assumptions in determining whether it's going concern. What assumptions do you make about the future? What testing did you do? Did you do any scenario planning, reverse testing, that kind of thing? Similarly, sensitivity analysis is an area that continues to be of concern to them, and they've applied their concerns in their review of the COVID-19 disclosures. You know, why were the ranges chosen? What are the assumptions of sensitivity analysis? And as it says there, extent of reasonable possible changes. Finally, I mentioned earlier on, back in the Rethink page, about some of their skepticism about the way we might explain the impact of COVID-19. And I said how they have some concerns about the use of APMs. They also have concerns about splitting line items between sort of COVID-19 and not COVID-19. They're discouraging that. They're saying it's likely to be highly subjective for you to be able to identify how much of any particular expense line is COVID-19 and what's not. Instead, provide qualitative explanations of the impacts, or if you're going to try and provide quantitative, maybe do that on a time basis. How were you performing before 19? How are you performing afterwards? Next slide, please. And with that, I will pass back to Elisa for other financial reporting news.
That's great. Thank you, Anthony. And yeah, so in terms of other financial reporting news, there hasn't actually been an enormous amount happening in our financial reporting world otherwise in the last few months. Some of the sort of less urgent projects and things have been either delayed or put on hold by standard setters and other parties. But let's take a look at what we do have. So firstly, IFRS 17 insurance contracts. Now, IFRS 17 was issued back in 2017 after a very long-running project to come up with some IFRS principles for companies with insurance contracts, and that is something important to take note of for those of you who are corporates before you switch off entirely. IFRS 17 is a standard on insurance contracts and not just for insurance companies. So occasionally corporates may need to apply it too for certain arrangements. Anyway, this standard was issued in 2017 and companies were given an effective date of 1st of January 2021. And now, so various affected companies and stakeholders have been working through implementing this new standard, which does introduce very fundamental changes for insurance accounting. And there's basically been a lot of feedback raised. And so the ISB has been working on a project to make some changes to IFRS 17. And those changes, after a process of exposure drafts and consultation, have now been finalized with the final changes issued in June. And one of the changes was to defer the effective date of IFRS 17 until periods beginning 1st of January 2023. So these amendments address many, though perhaps not quite all, of the concerns raised by affected parties. There are some clarifications and simplifications to how IFRS 17 will be applied and to ease the transition process. Since this is quite a specialist area, we won't go through all of this in detail. Some of the topics covered by the changes are on the screen, so you can see the sorts of things covered there. And we do have a publication, an International Financial Reporting Bulletin, which has more information about those amendments. All right, next. IS1. So earlier this year, there was some amendments issued to IS1 on the subject of the classification of liabilities as current or non-current. So we've talked about this in an earlier webinar in April to explain those changes, and the three of the key concepts are on the screen there now. We won't go through all of it, but basically there could be some potentially significant effects for some companies of which of your liabilities will be classified as current or non-current. Now, these amendments were due to be effective for periods beginning on or after 1st of January 2022, but because of COVID, this has now been deferred by 1 year to 1st of January 2023 to give companies a bit more time to prepare. So I think it's worth highlighting that in deciding to defer the effective date, the ISB noted that for some companies, these amendments could have a significant effect, and that's why they thought more time was needed. So, for example, companies might want to or need to renegotiate some of their bank loan covenants because these changes might perhaps mean that you might not be meeting certain covenants anymore. So that's why we've now got 1 more year to work on these changes, but we would encourage you to take a look at this, and if you do expect a material change in balance sheet classification, then that's something that probably in this year's accounts you should be disclosing under the new standards not yet adopted disclosures. Okay, next then is back to IBOR reform. I think we've talked about IBOR reform for a long time now in every single webinar, and that's because this has been a long-running project in the last couple of years for the ISB to make some changes to IFRS to help companies with what's happening about the reform of interest rate benchmarks. And so we have had two phases to this from the ISB, the Phase 1 amendments and the Phase 2 amendments, both of which are on the screen at the moment. And basically, the ISB has now finished with this project by issuing the final Phase 2 amendments. So just as a reminder there, the Phase 1 amendments, which are already effective, addressed accounting issues during the period of uncertainty before IBORs are being replaced. And the main aim of that was to provide some relief from specific hedge accounting requirements to avoid discontinuation because of uncertainty about IBOR reform. And now the Phase 2 amendments are aimed at addressing slightly more issues at the time when the IBORs actually are replaced by different interest rate benchmarks. So this broadly relates to two areas, one being the rules about modifications to financial instruments, what you need to do there, and again, hedge accounting. So the Phase 2 amendments will be effective from 1st of January 2021 with early application permitted, subject to endorsement. This does need to be endorsed by the EU, and for UK companies, if that process is not completed by the end of the current year, being our Brexit transition period, then they will need to be endorsed by the new UK endorsement body. Preparations are underway for that, and the FRC has in fact already published some information related to that. For UK GAAP preparers, FRED 74 was issued back in May, proposing similar changes to UK GAAP. Okay. Right. Oh, yes, we've got just a little bit more on the nature of the Phase 2 amendments. We did talk about these in our last webinar, but the three key effects. So basically, where you have changes to the contractual cash flows of financial instruments, we often call those modifications. So if you've got a change because of IBOR reform, so maybe you've got a bank loan that's got interest based on LIBOR and a margin, and at the time of the change, this changes from LIBOR to SONIA, for example. So what do you do? Does that have any accounting implications? So what these amendments say is that an entity will not have to de-recognize or adjust the carrying amounts of their financial instruments for such changes, but can use a practical expedient to update the effective interest rate to reflect the change to the alternative benchmark rate. And this means that you wouldn't be getting gains or losses in the income statement because of that. So secondly, on hedge accounting, companies will not have to discontinue hedge accounting just because of the changes to IBORs from the reform if the hedges continue to meet other hedge accounting criteria. And finally, in terms of disclosures, the amendments introduce additional specific disclosure requirements for information about new risks arising from the reform and how companies are managing the transition to alternative benchmark rates. So do take a look at those if you have got things like, for example, loans linked to LIBOR and hedge accounting for things like interest rate swaps in the UK. Okay. Finally, or moving on to UK GAAP. So we've mentioned two changes to UK GAAP already. So that was just now for IBOR reform. We've got FRED 74 for proposed amendments out there. And Anthony also mentioned FRED 76 for proposed changes to lease accounting for those COVID-related rent concessions. In addition to that, the FRC issued FRED 75, which is proposing some changes in relation to going concern to FRS 104. Now, FRS 104 is not necessarily a standard that all that many companies are using, and so this is for interim financial reporting under UK GAAP. So what this proposes is to clarify the requirement to assess the going concern basis of accounting and to require the disclosure of any material uncertainties when preparing interim financial statements under FRS 104. Now, this may not sound like something new, and in fact, FRS 104 already effectively requires the assessment of the going concern basis because companies would need to include a statement that the same accounting policies have been applied in the interim report compared to the last financial statement. So to say that, you've got to think about going concern. So that's more of a clarification and more of a specific change perhaps or clarified requirement is that you must disclose any related material uncertainties related to going concern in an interim report in the same way as you would for an annual report. And these will be effective if finalized for periods beginning on or after 1st of January 2021. Okay. So that actually brings us to the end of news about changes to current standards under both IFRS and UK GAAP. So as our final topic, we thought we'd tell you about something a little bit different, which is a topic that the IFRS Interpretations Committee has recently looked at and given some comments on. So this is a topic that's been quite topical in recent years, and that is the accounting for supply chain financing arrangements, specifically reverse factoring. The FRC has commented on a few occasions over the years on the accounting for these and disclosures about reverse factoring arrangements. And so now the latest, and as have other regulators and other parties, but it's not been something specifically addressed by IFRS. So now the IFRS Interpretations Committee was asked to ask some questions about this, and they've given a tentative agenda decision after their June 2020 meeting. So this is a tentative agenda decision, so it's currently subject to consultation, and but we thought we would tell you about it because at the moment, under the COVID-19 circumstances, we're aware that that there could be an increased use of these facilities by some companies, and that might make the accounting considerations particularly significant and relevant. So, okay, what exactly do we mean by supply chain financing arrangements, just to make sure we're all on the same page? So supplier financing or reverse factoring arrangements are offered and used by many companies, and these are arrangements where a financial institution agrees to pay amounts an entity owes to the entity's suppliers, and the entity then agrees to pay the financial institution at a date later than the suppliers are paid. So supplier financing arrangements have become more prevalent in recent years as companies have been looking to manage their working capital and cash flow positions as tightly as possible. They can be of benefit to both purchasers and suppliers. So the purchaser effectively gets longer to pay, which can help their management of working capital and reduces the administrative burden of paying multiple suppliers. The suppliers, on the other hand, are paid more quickly by the bank than they would be by the entity. Effectively, they're receiving credit based on the purchaser's credit rating. And this could be better, especially where the supplier is a small company with a limited credit history. The discount given by the supplier is typically less than the amount of interest they would have to pay if they were to borrow funds on a short-term basis from a bank while waiting for purchasers to pay. So, the accounting for such arrangements is not directly addressed under any accounting framework, which perhaps not surprisingly has led to diversity in practice for balance sheet presentation and cash flow presentation. In addition, disclosures explaining the nature of these arrangements and how they're accounted for are often quite limited or non-existent. The lack of guidance means that the same type of arrangement could be accounted for differently by two different companies. For example, some companies might show their liabilities as a trade payable or an other payable, whereas others might be showing them as debt or borrowings where they have factored their invoices payable to a financial institution. This makes it harder to compare balance sheets, and there is an argument that limited disclosures could effectively disguise the extent to which companies have used such facilities to prop up their cash flows. A notable recent example where such a criticism was made was, of course, Carillion. So, acknowledging this problem, the IFRS Interpretations Committee issued a tentative agenda decision. They were asked to consider, firstly, how an entity should present the liability to which the arrangement relates on the balance sheet, and secondly, what information should be disclosed. So the committee concluded that with reference to IS1 in particular, but also other standards, liabilities arising from supplier financing arrangements should be presented separately from trade payables or other payables if the size, nature, or function of those liabilities makes separate presentation relevant to an understanding of the entity's financial position. It also stated that entities should consider the amounts, nature, and timing of those liabilities when assessing whether to present such liabilities separately. So they tried to give some guidance there about the classification based on existing IFRS requirements and give some guidance about disaggregation between trade and other payables too. The company included the committee included some indicators in the grey box on the screen for entities to use to help them form a judgment, and this can be a judgmental matter, about the classification of supplier arrangements. So those factors to consider include whether there's any additional security that's being provided as part of arranging to factor invoices in this way. That would not be provided without this arrangement, and whether the terms of the liabilities that are whether or not they are substantially different from the terms of the entity's trade payables otherwise. So the committee noted that the derecognition requirements in IFRS 9 need to be considered for liabilities that are subject to reverse factoring. If trade payables are derecognized, then the company will apply IS1 and other relevant standards, as well as the factors and considerations we've just talked about, to decide how to classify the new liability. The committee noted that the presentation in the cash flow statement, in turn, should generally follow the assessment of the nature of the liability on the balance sheet. We'll come back to this on the next slide, but just to note that on that second question that the committee were asked to comment on, being about which disclosure requirements would apply, the committee emphasized and noted that IFRS 7 has disclosure requirements about liquidity risk, which would typically be relevant in guiding companies about what to disclose about these types of reverse factoring arrangements. Also, that the IS1 disclosure requirements on judgments would likely be relevant. So on the cash flow statement presentation, as I just said, the committee noted that typically this would follow the nature of the liability on the balance sheet. So, for example, if a company considers the liability related to a supplier financing arrangement to be a trade or other payable, that is just part of the working capital used in the entity's normal revenue producing activities. In that case, the entity will present the cash outflows to settle that liability as arising from operating activities in the cash flow statement. In contrast, if the entity considers that the related liability represents borrowings of the entity, so for example, if they've de-recognized the trade payables and recognized a new liability as borrowings, then the cash outflows to settle that liability would be shown as financing activities in the cash flow statement. However, presenting the cash flow that way effectively means that there would be no cash outflow in the operating section to represent the purchase of goods or services. In this circumstance, the committee clarified that the entity should provide clear disclosure of a non-cash transaction, which is a specific requirement in IS 7, to explain the drawdown of borrowings in exchange for the factor taking on the trade payable liability to the supplier. Due to the current lack of clarity over how you should present these cash flows, there is some practice in the market for some companies to take a different approach where they've opted to sort of gross up or present notional operating cash outflow for settling trade payables and a financing cash inflow for borrowings. So there are arguments for that approach too, but basically based on this tentative agenda decision, it seems that the IFRS Interpretations Committee does not endorse that, which would be consistent with what we've previously heard also from the FRC. So as I said, this is a tentative agenda decision. It could still be subject to some changes, but if you do have these types of supply chain financing arrangements, worth taking a look at this guidance and thinking about how you show such arrangements in your accounts. So that brings us to the end of our news updates today. Just to finish off, we'd like to share with you some recent other new publications other than the ones already mentioned. And you can find these on our BDO UK and BDO Global websites. And these include, for example, a new quite comprehensive IFRS in practice document that has been recently updated for IFRS 15 revenue, as well as IS 36 impairment of assets. The impairment one includes some specific guidance on COVID-19 considerations as well. Also, we have an updated version of our guide on preparing the strategic report, which explains how to go about writing a strategic report and guidance about the requirements. Has some useful tables and links to the legislation and guidance about which requirements apply to which sizes and types of companies. So do take a look at those and other BDO publications. And with that, I'd like to thank you for joining us. I hope you found it useful. And now I'm just taking a look if we've got any questions that we can answer. I think we haven't got any at the moment. Yeah, okay, that's been confirmed. We've got no questions at the moment. So thank you very much, and do join us again for our next webinar. Thank you.